Hey everyone, back with the BPA project chapter 7 on outside bars of trading price action trends. It's a relatively short chapter, so I tried to add as many examples as I could. That's what helps me learn, seeing the same example over and over again in different contexts. So I hope it helps all of you as well. So I'm going to start with the definition of an outside bar. And I have it classified in three ways: strict outside bar, implied outside bar, and functional outside bar. Al doesn't define them in these three ways, so you can choose to ignore it if you want to go strict by the book. But these classifications help me separate them in my mind, even though they're traded in a similar way. It just helps kind of understand the concept. So a strict outside bar is when the current bar is completely outside the prior bar. So the low of the current bar is below the low of the prior bar. So low is smaller or less than the low of one bar prior, L minus one. And the high of the current bar is greater than the high of the prior bar. So that's a strict outside bar. There's also an implied outside bar, or what Al calls it, an almost outside bar. So the implied outside bar or the almost outside bar is when one extreme is outside the other. So for example, in this case, this high is greater than that high, but the lows are equal. So it functions as an outside bar. It's good enough, and Al often says that with these patterns, when they're good enough, they'll function the same way. So the lows are equal, but this high is greater than that high, so it's still an implied outside bar, and you can treat it as an outside bar. And in this one, the highs are equal, but the current bar's low is below the prior bar's low. So this is clearly outside that low, but these highs are equal, but still functions as an outside bar. And the last classification is a functional outside bar. And Al says, in a situation where the second bar of a two-bar reversal goes above the prior bar, especially if the bars are large, you should treat it as an outside bar. And if you're treating it as an outside bar, what that means is that you have to treat it as a trading range. And Al says it's usually not a good idea to enter on a stop above an outside bar, especially if the bars are big, because the stop is far away and it's essentially a two-bar trading range. So it's usually better to wait for a higher low pullback and then buy for bulls to prove that they're protecting the low and that they're going to come in at a higher low and continue the trend or continue the move up. So I'll show some examples of functional outside bars. This is an example here. This low is not below that low, but the high is above this high and the bars are big. So this Al would classify as a functional outside bar, something that, again, that's not his classification, but it's something that he would consider to be an outside bar and should be treated as such. Now, I think there's an important concept with these bars that kind of clicked for me a little while ago, that every signal bar is a sign of a potential outcome. So it's a sign that an outcome is possible. So if we had a small bull inside bar here, you could say one leg down, triangle, or trading range, and then second leg down. And now this is possibly a failed breakout in a bull context after a gap up. And if you had a small bull inside bar here, you could bet on a failed breakout that will test the apex of the triangle. So the sign or the signal is a small bull inside bar, and the outcome that you're looking for or the target is the apex of the triangle. And then you might get 2-to-1 or like 2R out of it or 3R out of it, and it would make sense mathematically. But with a bar like this, something this big, this is the sign and it's also the outcome, all encompassed in one bar. Once this bar reaches all the way up here, it has already accomplished its goal. So buying above here doesn't create an edge. And that's why Al says with these outside bars, including functional outside bars like this, it's better to treat this as a bull breakout, as an impulse, and wait for bulls to prove that they can protect the low. So wait for them to get a higher low, and then buy once they've convinced traders that the bulls are in control for a possible bull channel or bull trend. So here we've reached a target. It's a possible buy vacuum test of resistance. But then once bulls get a higher low and then another higher low here, this forms a small triangle here, and then we get a breakout and follow through above the moving average. Then that convinces bulls to start buying to close or buy below this bull bar, looking for a couple legs up. So for outside bars, functional outside bars included, Al says it's better to wait for a higher low before buying and not buying with a stop because it's just a two-bar trading range. And I have a lot of examples here. Here's another functional outside bar. This low is above this low, but this high is above this high, and it's two large bars, big down, big up. It's a trading range. Better to buy a pullback. So in this case, I bought with a limit order at 50%, but you don't have to buy with a limit order. You can wait for it to start to reverse up, and then you get a reversal bar, and then 12 closing above 11. You can buy the close of that. You can buy during 13. But again, better not to buy above the outside bar because it's forcing you to buy at 50% pullback in a possible trading range after a bear leg down. So wait for bulls to prove that they're holding the low at a higher low. Here they get a micro double bottom, and then you can start to buy at a higher low. Same concept here. It's one bar breakout of this trading range, reverse up as a functional outside bar, not worth buying the high. Wait for a pullback with 50%, buy with a limit order at 50%, or wait for the micro double bottom and then bull bar on 31. And Al, I think, I don't know if he marked this on the end of day chart, but he talked about this in the room, that it was very reasonable to buy above 31. Another example here, we have a strong spike down, and then we have 3 legs up, possible wedge bear flag. And I actually did sell below 47. And it's something that I knew, but it just wasn't solidified. The concept wasn't solidified that this is a functional outside bar, and it's possible low in a bull channel, so not a good sell. And so bears who see this, yeah, it's 3 pushes up, and it's a possible wedge bear flag, but this bar is too big, and it's possible big down, big up, big down, and a sell vacuum test of support in a bull channel. So bears, if they follow Al's rule to the T, you don't sell below 47. You wait for a lower high to prove itself, and it never happened here. So bears never proved that they had control of a lower high, and so a bear could stay out of this and instead start to go long when bulls prove that they have control of the market. That's important. If you follow that rule to the T, it would keep you out of this trade, and it would have kept me out of the trade. And now I'll show some examples of sell climaxes. So we have rally on the open, and looks like it's going to be a trading range, but instead we collapse down and get consecutive sell climaxes. Then we get a huge bull outside bar. So bears are selling the closes, selling below bars, and then they sell below this last bar on 63, and it reverses up sharply. Even then, it's probably okay to buy above 64. I think Al mentioned that in the room. But again, just Al's general rule is wait for a higher low. And you can buy with a limit order at a higher low, or you can wait for it to start to reverse up. But in general, these outside bars typically get pullbacks. So no need to be impatient and buy above that. But I think it's okay when the odds are that we're going to get a couple legs sideways to up after a sell climax. Here as well, rally, trading range, and then bears take control, 2 climaxes down, and bulls get an implied outside bar, so an almost outside bar. It didn't go, it was, the lows are equal, but the high of this bull bar is higher than the prior bar, so it's an implied or almost outside bar. And again, no rush to buy the close of 49 or buy above it. Bulls got a pullback. On this day, Al said it's reasonable to buy below 50. So bulls don't need to rush to buy high because it's an outside bar. It's big down, big up. And a lot of bulls will wait to buy 50%, or when it starts to reverse up above 52, above 53, and look for a couple legs up. Now here's an example recently where we had the outside bar after consecutive sell climaxes, and we didn't get a pullback. So a trader who waits for the pullback, in this case, would miss the trade. I think that's fine. I think it's very context dependent, as Al mentions in the book. So if the trader concludes that this is an upper range and it's going to be a trending trading range day, and we know that from Al's rules that if you have a trending trading range day, the odds of getting at least 1 tick above the low of the upper range is 60%. Then if you see this bar and you have 1 R to the low of the upper range, that's a reasonable trade for 60% chance if you believe that these consecutive sell climaxes and the breakout and the bear leg. And so if the bear leg is done and we're going to form a trading range, there's a 60% chance that we're going to get above the low of the range, the upper range. And so there's probably a way to structure it that makes sense. But in general, outside bars are better not taking with stop orders unless the context is very good. So context is key. Outside bars are functionally trading ranges. They're big down and big up. So they're 2 bars that overlap entirely. And Al says it's almost always unwise to enter on a stop above or below an outside bar, signal bar, especially when the bars are large. And he says the most important thing with outside bars is just wait if it's unclear. And what do you wait for? You can wait for a higher low, as we talked about here. Wait for the bulls to start to protect a higher low, or wait for follow through. So on this day, we had an outside bar here on bar 22. And in the room, Al was saying, well, the Globex low is just below, and we might test the Globex low. And it's an outside bar 22. So Al didn't buy above 22. He waited for follow through 23, and then as the market started to race up on 24, he bought. So that's a sign of being patient and waiting if it's unclear. You have an outside bar, possible big down, big up, possible trading range. So wait for the bulls to prove something. In this case, they've tested down on 23 and then closed as a bull bar on 23. So that's kind of a higher low test. And then when bulls started to race up, Al bought. So the next section is, when is it okay to buy with stops above an outside bar? So normally Al says it's probably not a good idea, but when is it okay to do that? And he explains that when you're trading with trend and you have targets above, you can obviously be more lenient because trends are very forgiving. So here, for example, you have a test down, moving average gap bar, second entry buy, above 48, and then you get an outside bar 49. You can wait for follow through and buy the 50 close, but in a strong trend and a moving average gap bar, it's not unreasonable to buy above 49 because you know that there are swing targets above because you're in a trend. So there's a lot of room to the upside. And so you're likely to get back your risk and more, and 2 times your risk, if you're trading with trend. Here's another example with trend. We have 2 legs down, 1 pullback 2. It's a moving average gap bar, second entry buy. We go outside up on 53, not a great signal bar. But then we go outside up again on 54, which is an 0-0 buy setup. And these lows are equal, but it's an implied almost outside bar. So bulls who buy above 54 with a stop below, the bar is big, but you're buying in a strong bull trend after a small pullback bull trend and first pullback to the moving average for a moving average gap bar. So Al says the odds are high to at least test the extreme, but can also be taken for a swing, and you get way more than twice your risk if you actually hold for a swing here. Another time it's okay to buy with stops is when you have major moves with targets far above. So a major move is more important than the local trading range of the outside bar setup. So for example, in major reversals like this, we have a move down, triangle, possible final flag, and then a last leg down. So it's a possible major reversal, and you get breakout, breakout, pullback, and then outside bar. That's a reasonable buy because the target is far away. You're looking for a major reversal. So in these kinds of situations, Al says it's okay to buy. Another example here, we have bear trend, breakout to the moving average, and then possible lower major trend reversal. So this is a functional outside bar. And Al mentioned on this day that it was okay to buy above 55. And here's another example. We have a lower major trend reversal, break, and then higher low major trend reversal. Starts with an outside bar. So bulls will buy above that, looking for a swing up after a higher low major trend reversal. And they'll expect 2 legs up. I'm not sure if I explained that properly here. The major move is more important than the local trading range. It means that, yes, an outside bar is a trading range of its own, 2-bar trading range. But if the overall context shows that there's a lot of room to the upside, then you can ignore that small trading range because you know the targets above or the magnets above have enough of a reward to offset that slightly lower probability. And another time Al says it's okay to buy with stops is for trendline overshoots, and we'll cover that more in the reversals book. And finally, one important concept that he talks about here is that strong reversals from higher lows become leg ones. So for example here, you have the lower low major trend reversal, and then bull rally, and then a higher low major trend reversal. It starts with an outside bar. So here, bear sold below there, got trapped. We got an outside bar and then a strong bull breakout. Al says that even though this is the start of the move up, this higher low is the area where bulls took control. So we got a higher low, outside bar, and then bull breakout. So Al says treat this as the beginning of leg 1. So bulls should get 2 legs up from the confirmation of the higher low. So we should get 1 pullback 2. And this is a strong breakout, might get another leg up of its own, but that's the minimum criteria. And so I think a mistake that I used to make is say, for example here, it's a bear channel, and then we get breakout, so it's the first break above the moving average, and then pull back to a possible higher low major trend reversal, and then break out to 43, and that's 2 legs up. So maybe that's the end of the move. But Al says when you get a higher low and then you get clean, strong buying, an outside bar, and it shows that bulls are protecting a higher low, that's the moment where all traders decide that bulls are in control. And so we should get 2 legs up from that moment. So either 1 pullback 2 or 1 pullback 2. But this can be seen as a possible leg 1. And same with this. We have spiking channel, then we get a break of the trend line, test of a higher low, and then this is a functional outside bar. It doesn't quite go below, but it acts in a similar way because it's a very strong buying from a higher low. This is probably a little bit loose of a definition for outside bar because 54 isn't actually a big bear trend bar. But the concept is is the same. That we start to get proof that bulls are buying at a higher low, and when they get 55, 56, it shouldn't be seen as one pullback, two, and now we have two legs up in a bear trend, and we look to sell. This is the proof of bulls protecting a higher low, and so this is actually the first leg. Leg one, pullback. Leg two, and maybe even if this is tight enough, leg one, pullback, leg two. And I think that's an important concept. It's going to be touched on more later, but that's something that kind of tripped me up a little bit in the past. So this can be seen as the start of leg one. Another way to look at it, something that Ali talks about a lot, is to see this move down on the higher low as part of this bear trend. So bear trend, break, and then small second leg sideways from this trend. So this is still part of the move down. And then when bulls prove something here on 55, 56, that starts leg one. That's a good way to look at it as well. And Al says, outside bars are better when they come after good signal bars. So why is that? So here, for example, we have the signal bar on bar 4, and instead of going above it, it went below it and then triggered above bar 4. So what happens in this kind of situation, instead of an outside bar like this, where it's big bear bar and then big bull bar, in this kind of situation, what we're getting is this. So we're getting the move down on bar 3, and then we're getting a bull bar, then we're going below the bull bar, and then we're going above it. So this is actually functionally acting as a lower low major trend reversal on a lower time frame, because we go down on 3 and then up on 4, which breaks the trend line, and then down below that to form a lower low major trend reversal. So that outside bar means more than just a big bear bar and a big bull bar, because we're actually forming a major trend reversal on a lower time frame. If you compare that to this, we have 4 consecutive bear bars. This just looks like this. So it's just a V reversal. And so that's why Al says wait for a higher low, because V reversals are very rare. So it's more likely to be, this is the first break of the trend line, and then we need a higher low major trend reversal, which is this higher low on the current time frame. On a lower time frame, it'll form a full higher low major trend reversal. And so that's why when it's big bear bar, big bull bar, it's better to wait for that higher low. And here's another example. We have breakout pullback to a higher low, and instead of going above the bull signal bar, it went below it and then raced above it. So that's also a better type of outside bar. Now, one important thing to mention is that in these kinds of situations, Al also says that you don't have to wait for the outside bar to form and buy above the outside bar. You can actually buy as it's going above the bull signal bar. So on this day here, Al said, you don't have to wait to buy above 5. Once it goes below 4 and then starts to race up above 4, you can just place your buy stop above 4, because you may have bought above 4 either way. But then now it's going outside up, which increases the odds because it's a second test down. So bears get the second test from bar 3. After the surprise bar 3, we get a micro double bottom, and then we get the trigger above the buy signal bar. So with these kinds of outside bars, Al says that it's actually okay to just buy above the signal bar as it goes outside up, instead of waiting for the outside bar to form. But of course, context is key, so the context has to make sense for that. The next section here is outside bars become IOIs. So when you have an outside bar, it's engulfing the prior bar. So here bar 10 is engulfing bar 9. When you get an inside bar that comes after it, it becomes an IOI, inside, outside, inside setup. That's still a trading range. So Al says, only take the IOI trade if there's room to targets above, because it's still a local trading range. Here, you're betting that it's the low of day because it's a big gap down and you're trying to get a reversal, an opening reversal. So when you buy above an IOI here, if you buy above bar 10, then you're looking for it to be the low of day. In this case, it was. But what Al did on this day is he actually bought above 9. So as it went outside up, like I talked about earlier, if there's a reasonable bull signal bar in a reasonable context, instead of waiting for the bar to go outside up and then buy above that, he just bought as it went outside up above 9. And he places stop order above 9 because now we have a micro double bottom and it functions as a lower low major trend reversal on a lower time frame. And then he bought above 9. Here's another example where 6 wasn't a great signal bar. So it went outside up and then we got an inside bar. So that's an IOI buy setup. Again, you're betting that this is the low of day. So if you buy this, it's 3 pushes down, 1 pullback, 2 pullback, 3. And you're looking for this to be an opening reversal, double bottom bull flag 1, 7. And so if you buy that, it's an IOI and it's a local trading range, but you're betting that it's a low of day and it can travel 2 or 3 times your risk, which it did in this case. The last section here is outside bar fades. And because outside bars are trading ranges, Al says that in many cases you should be looking to fade the outside bar instead of take it in the same direction of the outside bar. And so in trading ranges, outside bars should not be used to generate trades because it's a trading range within a trading range, unless there's a small bar at the extreme of the trading range, because trading ranges is buy low, sell high, and scalp. And so if you have a 2-bar reversal that looks like an outside bar setup, and you're high in a trading range, you want to see a small bar at the extreme of that trading range to then sell. So here, for example, we have a move down in a tight bear channel. 23 is an outside bar, but it's forcing you to buy at the high of this local trading range in a bear trend. So not a good buy above 23. But then you get a second entry sell 26 at the high of this range, testing the breakout point here, testing the moving average. So now you have a trading range, you have an outside bar, which is a trading range, and then you get a small bar at the high of that range. So that's a sell below 26. Same thing here, we have a tight bear channel, and then we go outside up on this bull bar. It's a buy signal bar, but it's going outside up in a tight bear channel. So it's more likely to be a double top bear flag instead of a double bottom for a reversal. So you have an outside bar, which is a trading range, and then you get a small bar here at the top of that tight trading range. That's a sell below that small bar. So you're fading extremes in a trading range, in a tight trading range. Here's another example. Bear trend, strong bear spike, probably going to get a channel. And then you get a functional outside bar here on 14. It doesn't go below 13, but it goes above 13. And so that's a functional outside bar. But it's happening in a bear trend and near the high of this trading range. So instead of looking to buy above that, traders will look to sell a small bar. This is a little bit bigger, but because it's with trend, you sell and fade the outside bar for a trend resumption. Here's another example, tight bear channel. You get a bull signal bar, but it's an outside bar, possible double top bear flag, more likely double top bear flag than double bottom for a reversal because it's a tight bear trend. So here it doesn't give you the opportunity to sell a small bar at the highs, but it's enough to just not take that trade because it's an outside bar in a tight bear channel. And then here's another one. This is the opposite case. It's a bull rally, strong bull rally breaking above the moving average. And then bears get a second entry sell, which is below 60, but it's an outside bar and it's coming after a rally that's probably going to get a second leg up. So this is more likely a double bottom bull flag and not a double top for a reversal. And so bears should not be selling an outside bar in this kind of context. In fact, it's more of a fade. So that pretty much covers the topics of this chapter. It was a relatively short chapter. I went through it pretty quickly, but I hope it was helpful. I hope you found the examples helpful. If you have any questions, I'm happy to try to answer them. If you have any comments or feedback on my analysis and see anything a little bit differently than me, I'm happy to discuss and learn together. So yeah, I hope it was helpful. I highly recommend reading the book because Al goes into a lot of detail when he breaks down the charts and talks about a lot of topics that kind of come from other chapters as well. So it's a good way to mesh everything together when he does his bar by bar breakdown for the charts. So I highly recommend that. But obviously, if this helps, I like making them, and I hope that they're a good supplement for the book. So take care, have a good weekend, and I'll be back Monday for my trading.